So welcome. My name is Scott Phelps. I'm a tax manager with Blankenship. Appreciate everybody being here this morning. Obviously, by the size of the room, that we have some people that are very curious and very interested about this new bill. We're looking forward to trying to help expand a little bit on Dr. Young's presentation from this morning. Very grateful for the information she's presented. My goal here is to try to walk through a couple of scenarios just to give a visual aid to what some of these changes will look like and how your situation might be impacted. We're going to give another warning that you'll probably hear a few more times is please do not take any action on anything you hear today until you talk to your CPA. Your individual situation, it truly depends. And so we need all the details. So again, if you're thinking about doing something based on what you've heard from any of the speakers today, please talk to your CPA first. We would love to walk through all the numbers, all the details, and be able to advise you so that we're not having to then walk something back down the road. So we'll go ahead and get started. So today we're going to cover three areas. I'm going to give three scenarios, and then we're going to walk through a couple special areas and then open it up for some question and answer. The three scenarios, as Dr. Young said, the bulk of the changes are happening on page 2 of the 1040. We're going to take a very high-level look at this and say that our incomes are going to be, there's nothing special, basically saying all W-2 income so that we don't have to worry about different rates and changes. And so really take this as a very simplified version, but hopefully it gives some framework for what's going to be happening. 2017 and prior, the statistics were telling us that about 75% of the population were taking the standard deduction, and then that left 25% taking the itemized deductions. Congress's hope with this new bill is to cut that down to only 10% of the population taking itemized deductions, which would make 90% taking the standard. So what we're going to look at is the 10% that will still itemize, and really this is still the bulk of our client base. We're anticipating that a number of folks in this room will still fall into this category. Then there's going to be the 15% that are switching. You did itemize in the past, now you're taking the standard deduction, and then the last is going to be you were taking the standard deduction before, and will continue to. So all of our scenarios, we're going to utilize a couple, married, filing joint, 3 children, 12, 15, and 18. The ages will have some significance. Starting off with our couple that will continue to itemize. So we have a higher AGI, $600,000 in both years. You'll see in 2017, we have 130,000 itemized deductions. However, it's going to be limited by piece, and so so we're having some of that 130 scaled back to only 121. 2018, because of the state and local $10,000 cap, that 50,000, even though there may be 50,000 of state and local taxes, only the 10 is going to be applicable. And an important note is that 10,000 that has not been indexed for inflation, and so that 10,000 will remain 10,000 through the course of this bill, which sunsets at the end of 2025. Mortgage interest will stay the same, charitable deductions stay the same, and then again 2% miscellaneous deductions, those are going away for 2018, and again through the end of 2025. So we see our total itemized deductions, we're going from 121 to 85. So our taxable income, we're actually lower with taxable income in 2017, higher in 18. However, our tax is higher in 17 than it is in 18, and that's a function of the changing of the not only the rates but the tables themselves. So our 2017 filer, under these circumstances, is in the highest bracket. This person is in the 39.6% bracket. Under these same circumstances in 18, they actually have fallen down in that second highest bracket. There's a marginal rate of 35% instead of the highest 37. And then again, we see that A&T plays into the picture in 2017. So a much higher tax due at the end of 2017 than in 2018, and so in this special circumstance, our taxpayers doing much better under the new bill. And then we'll pop forward to the next example. And so now we've got our couple that are now, they used to itemize, and now they're going to take the standard deduction. So in 2017, they had $20,000 of deductions. Obviously, that's better than the 12.7, and so that's what they're taking. But in 2018, now 24,000. Obviously, want to take the higher number. Now our exemptions, we have 5 exemptions. So we have the married couple and 3 children, or 3 dependents. So we're having 20,215 exemptions, but in 2018, and again through the end of the bill, those exemptions are going away. So we have lower taxable income in 17 than in 18. It's slightly deceptive. If we were just to look at this tax line, it would kind of look like that's what would happen if they had no children. However, we have to take into account that we have 5 exemptions. If we were to scale that back to just the 2 for the couple without having children, then actually that tax would be almost equal to the 2018. I ran it and it's $15,700. So really this person with no children would pay higher taxes in 18, but it wouldn't be as significant as what this line would show. But our couple does have children, and we'll see where in 2017, the 2 children, 12 and 15-year-old who qualify for the child tax credit, they're eligible for up to $2,000, but because of the phase-outs, that's been limited to $1,250. 2018, those 2 children, 12 and 15, are eligible for the full $2,000 each. The phase-out is up to $400,000, so they're capturing every bit of that. And then our 18-year-old, because that 18-year-old does not qualify for the child tax credit, but is still looked at as a dependent, we now have the $500 family credit. So at the end of the day, this taxpayer pretty well is breaking even. You know, we have a little bit of a reduction in tax. And then we'll do our last example. This is, took the standard deduction before, we'll take it again. 100,000 of AGI, standard deduction of 12.7 goes to 2,400. Again, the exemptions in 17, but go away in 18. Higher taxable income in 18. However, because of the brackets and the way that the rates are structured, paying lower tax right off the bat in 2018. But then when we factor in the child family credits, we've now gone from 2,000 in credits, 4,000 for the 2 eligible children, plus the additional 500. So we're having, in this case, a much greater reduction of taxes. Some of the special topics that I also want to make sure that we're highlighting. If someone is taking a look at estate tax, those rates have doubled. So it was $5.6 million for a single, 11.2 for a married couple. Those rates under the current bill have been doubled to 11.2 and 22.4. Also important to mention that this also is one of the individual provisions that will sunset at the end of 2025. So there's some important estate planning things to consider with this, but also looking at what happens when this sunsets. And so those are conversations, again, please have with your CPA, probably also your estate attorney. Home mortgage interest, I know that was hit on a fair amount, but again, the new home acquisition indebtedness up to $750,000, the $1 million that had been available up until 12/15/17 stays grandfathered in, and so if you had a mortgage that had that level of debt attached to it, that carries forward. However, for new acquisition, then the cap is now $750,000, and that is on a principal residence plus one other home. And the importance there is, it's not just capturing the vacation home. It really was when people started looking at it. Congress originally was saying, well, just the one home. Well, that was going to create a problem if somebody bought and sold in the same year, because Congress was saying only one home. Well, then if you sold your home in the middle of the year, you would have to choose which of those homes you were going to take the deduction on because you could only attach it to one address. So that really, I think, had more to do with why they put the second home in than anything else. And then the refinance, refinancing is available. As long as the original indebtedness occurred prior to 12/15/17, it can still be up to the $1 million or $500,000 threshold. However, the amount of the debt cannot exceed the amount refinanced. So this is an area where if you're considering taking some action in the refinancing of a mortgage, and really the reason we've heard from a lot of folks is why would you refinance your mortgage is, well, this home equity loan interest is now non-deductible. That is not grandfathered. That is effective as of 2018. Home equity lines are not deductible, so there could be an option to roll that up into your mortgage. However, it has to be done very carefully, and it's something that we would highly encourage you to speak with your CPA, speak with your mortgage lender, make sure that you're not doing things that could blow it up for you and kick you out of the deductions entirely. The other thing that I want to highlight, there's some significant changes to 529 as well as the ABLE plans. The 529 originally was just for higher education, but this bill has expanded that to now include elementary and secondary education. And so the options now are far greater for utilizing a 529 plan. If that's an area that someone has an interest in, we would love to talk to you about it because there are some cool opportunities there. And then the ABLE plan, if you're not aware of an ABLE plan, Tennessee is one of 14 states that offers the ABLE plan. However, you do not have to be a resident of the state to participate. You can actually, it's like a 529, you can participate in any state plan that's established, but its intention is for individuals with disabilities. And it creates a savings vehicle that does not count toward their resources as far as Social Security and Medicaid are concerned, which that's been, if anyone has lived in that world or understands what that means, that's significant. That most folks with disabilities, they can only have, I believe it's $12,000 in total resources, so savings. And so this ABLE plan gives an opportunity to allow them to save up for things that they need that Medicaid may not provide, or that their insurance may not provide, or that their family may not be able to provide down the road. But say I have an individual that down the road needs a hospital bed, or needs a handicap accessible vehicle. That person is able to utilize that account to save up for those things, and then purchase them on their own without necessarily having to go through that same system. And one other thing in this bill that has been excellent is the 529 plan for an individual can be rolled into an ABLE plan. So, for this actually kind of hits home for me. I have a 4-year-old with Down syndrome. I'm hoping that my son is able to live a full and productive life and go on and do everything normally, but we don't know yet. He's 4. There's still some time. So we can start a 529 plan. We can anticipate my son's going to go to college. He's going to do these things. He's going to participate in those higher education activities. However, if we get 10 years down, probably 8 or 9 years down the road, 10 years, we're going to worry about the sunset, although I think this would probably get picked up again. But 8 or 9 years down the road before the sun sets, if we realize he's not going to do those things, well, then we roll that into an ABLE plan directly and are able to push all that money into his future. We talked about the family tax credit. This is replacing the dependency exemptions. So for those that were caring for an aging parent or grandparent, or for those children that are outside of the scope of the child tax credit, but either still living at home or going to school, or essentially the same definition for qualifying for the child tax credit holds true as the current law or the 2017 prior law on who a dependent was. And so this $500 is eligible for those individuals. There is not a refundable portion to that, unlike the child tax credit, where there's a up to $1,400 refundable portion of the child tax credit now. And then one of the other big changes, and this is an area that we're still trying to tread through and decide how to approach this, how to attack it, and it's also going to be a case-by-case decision, is the kiddie tax rules. Children are now, for unearned income, are going to be taxed at the trust and estate rates instead of the parent's marginal rate, so that's a big change. And then for their earned income, it's going to be at the single individual level. So, again, these are some big changes, and we'll create some tax planning opportunities and some areas where we'll have to look at, well, what do we do with the child? Do we even have this child file their own return? Do we continue to have it under the parent return? There's going to be some individual planning opportunities there. And then our other tax plan would be the bunching of itemized deductions. This is going to be probably more important going forward than it had been for especially some of our higher income earners. But also need to look at what's going to happen with the state and local taxes and how the $10,000 cap is going to affect that. So I know there's been a lot in the news and a lot of talk about paying real estate taxes early, trying to bunch up those. There are some provisions there. The IRS was very clear to say that they have to be not just paid, but they had to have been assessed. And so that's created some contention. What does it mean? Have they been assessed? And those are questions that we're happy to also help answer if you need help with that. And then let's go to the next one. So some perspectives that we as a team have had on the individual tax section. Generally, individuals will be paying less federal income tax. That's not across the board, but it's in general, most are going to be seeing a reduction of their tax because of the reduction in the rates, the changes in the brackets, again, the broader base, lower tax. Some of the concerns, again, our clients with state and local tax above the $10,000, 2% miscellaneous itemized deductions, where AMT liberalization doesn't offset. There will be some impact in this area. You were subject to AMT before, now you're not. But will the caps on salt and the 2% deductions affect certain individuals? Absolutely, there will be some individuals that will be negatively impacted by this. The double up strategy, as I mentioned before, is possibly attractive for those in the graduated brackets, less attractive for those in the highest bracket. So this was an area where we weren't always advising a middle income taxpayer to double up on those deductions, but now maybe that's changed. Maybe that will be a better strategy because those in the higher incomes likely are going to have more than $10,000 just in property tax alone, and so bunching up of those property tax payments is not going to do anything anyway. And then for those in the highest brackets, especially those with QBI, which I haven't mentioned at all in this session, and have been avoiding QBI not because it's not important, but because we're doing a whole session on it. And so luckily you're here at the first session. If you feel that you're at all impacted by QBI and you're interested, please go 2 doors down for the second session. It is a big sweeping change, and it does ultimately affect the individual because that's where it ultimately falls on the returns. But those with QBI who didn't have the domestic production activities deduction, the tax savings do become significant, and we're thinking that these could be really big. And so this is an area where we're kind of excited and looking forward to fleshing out the whole QBI opportunities, because we do see some very exciting things in there, some very exciting opportunities for clients. Finally, please have us run your projection. We have some great tools. We have some great ability to take into account where things sit now, where you believe they're going to be in 2018. Let's look at it as soon as we can, get ahead of it, and make decisions, because there's decisions that you can be making today, this week, next month. All of these changes are in effect today. It is 2018. This bill is affecting today and this year. So if you feel that you're going to be impacted in any way, please let us run your projections. Let us look at it and say, here's how we think this is going to play out, and give you the best opportunities to make changes, course corrections, do things differently, or just feel comfortable to say, I'm going to carry on the same I've been doing, and I'm good. I'm okay. So we'll open it up for questions, and again, I'll highlight please do not take action until you specifically speak to an individual or your individual CPA. Yeah.
On the home equity lines, if you use your home equity line to pay off your conventional first mortgage, there's plenty of room in there. You just want the flexibility of what a home equity line does. You go up and go down, you pay it off anytime, you line in it, lower interest rates. That still doesn't qualify, even though it's the first mortgage on the house, it's being tax deductible.
No, it does not. No,
Even if you show that you paid off your first mortgage with it.
they're pretty broad with it, and just saying if it's a home equity line, if that's how it's constructed, it is not deductible.
So
It's a pretty blanket.
You're saying possibly you could refinance it on a 30-year mortgage if you wanted to, if you took whatever the balance on a home equity line, just froze it, and then just roll it out to a long-term loan.
Possibly. Yeah, that could be an opportunity.
Add the cash out provision, there's a provision that you refinance and there's a cash out, and it's something like that, right?
Yeah, and that's correct. That if that there are. Do you want to speak to that? Because that's.
Correct. So if you have an existing loan that's going to carry over, there's no change. You still get the $1 million limit. If you have new original acquisition indebtedness, that's the long way of saying I bought a house, and the mortgage is the original acquisition transaction that allowed me to acquire the house, then you're at the new $750 for your principal residence plus one other. If you refinance an existing loan, and this was on one of the slides, as long as your loan balance doesn't increase, so you have a loan from 2017, 2018, you're going to refinance that loan. As long as your loan balance doesn't increase, you can still benefit from the $1 million limit. But if your loan balance increases, like rolling in your home equity balance into one loan, then that triggers the $750,000 limit.
Cindy's on that 750 mortgage gap. If you're above that, first 750 is still deductible, or is it eliminated?
First $750 deductible.
Yeah, first 750 is still deductible.
So where is office and home expense now?
Office and home, if we can, it does not go away if it's still existed on another schedule. So if it was in Schedule C, potentially Schedule E, then we can still capture there. That's the same with the mortgage interest. If you're hitting up against that $10,000 cap in mortgage interest on your personal home, but you have rental property, be that commercial rental or individual rental property, all of that interest can still be captured under that individual schedule. So those business mortgage interest still there does not affect the individual itemized $10,000 cap.
Sale of primary residence, so the amount has stayed the same, but what about, is it still 2 or 5 years, or is it 5 or 8
Yes.
years?
That is one where both the House and the Senate agreed on 5 of 8 years, but then it went to committee and they made no change. So it is still 2 of 5. That rule never changed.
So what about the rule that was put in place under the Obama administration that changed the ability to move to a secondary residence and for 2 years? Has that changed, or is that the same as it?
They did not touch the
But it's still.
sale of primary
The
residence.
appreciation when it was a second home is still taxable only. Is
that right?
that still the case?
That's where CPA.
Yeah, but that's probably we would need to sit down and talk through that, but overall that did not change.
So it is 2 of 5.
It's still 2 of 5.
Great.
Still have the ability to really sell 2 homes in a 5-year period and have no gain on the personal residence, whereas the 5 of 8, that was not going to be a possibility.
You said earlier that fewer people can itemize, who's going
those that were on the bubble of, maybe you were above the standard deduction of 12,007, but you're below this 24,000 that it's going to be, or for an individual 12,000. So if you're somewhere in the middle, that's where they were trying to catch it.
Over here.
Yeah.
What qualifies an 18-year-old for the family tax credit? What's the stipulations?
It'd be the same standards to say that they were a dependent before. So if they qualified in 2007, if they qualified under 2017 rules as a dependent eligible for the dependent exemption, those same rules apply to that 18-year-old. So if they're living with you, 50%. Yeah, if you're 50% supporting, if they're in school, those. So if their income is below a certain threshold, essentially it's those same dependent rules from 2017 carry to that credit. Yep. Yep. It does, yeah. So it's unearned income that's being taxed at the trust and estate rates. Earned income will be taxed at the single individual rates, which are published in the tax table. And that's the difference from it used to be at the parent's marginal rate. So whatever the highest bracket they fell into, that's what the child was taxed at. Yeah.
Is the threshold for long-term capital gains changed from 15 to 20%? Is that still the same income threshold?
Capital gains did not really change, and they've indexed the what those rates are. It's barely outside. It's about a $300 change between the top of that bracket.
I wonder if this is going to wind up being a technical correction, because under 2017, the break point between 15 and 20 matched up with the tax brackets. So if your marginal rate fell below 39.6, you had a 15% rate, and then if you were above, you had 20%. And they changed it to be a statutory amount that doesn't match up with the tax brackets. And what appears to have happened is that somebody picked up the 2017 bracket numbers and said that's the statutory amount, as opposed to saying it's the 2018 bracket definitions. So now it's just a little bit trickier about explaining where the break is, because it doesn't match up with that highest rate. But it's in the ballpark. It's within $200 to $300.
And I believe it's set to index.
Mm-hmm.
So again, it should be. They probably will line that up with the brackets just to ease it, but maybe they won't, and that would just be par for the course.
Inch more complicated to describe.
There you go. But if that's all, then we'll just say thank you so much for attending this event. We're very glad to have you.
Blankenship CPA Group is a top 10 Nashville public accounting firm that serves our clients' tax, audit, accounting, and consulting needs in the Nashville, Tennessee, and Middle South market through our experienced accountants in our Brentwood, Dixon, Goodlettsville, and Mount Juliet offices. At Blankenship CPA Group, we are not just another CPA firm. Our culture is built on the values of biblical servant leadership, service over self, and exceptional engagement and execution. We believe in building a team of spectacular professional people that share this conviction. This mindset extends not only to our clients, but to our families and our community. Working with Blankenship feels different because our people and our firm is different.